Hey, Blockhead Traders. Here at Blockhead Traders, I must inform you that we are not financial professionals. Nothing we say should be considered financial advice. We offer our own thoughts and opinions to you, the viewer. We expect you to take these opinions, form your own financial conclusions, and make your own financial decisions. Today is Wednesday, August 24th, 2022, and this is Blockhead Traders Weekly. In this week's episode, I am joined by fellow Blockhead trader Viper XL 007, and we are going to take a look back at some basics of option selling. And I think this is super important, Viper, to really kind of go back to some of the core fundamentals that we maybe take for granted that a lot of our viewers have, and just revisit that topic, reinforce some of that topic. But before we hop to that, I want to give a shout out to our Discord, a link in the description below. You can hop in there. It's free to join. You can say hello to myself, Viper, a few of the other Blockhead traders. Love to hear what you're trading. Love to hear the style you want to trade and what content you might want to hear about. Also, this is released as an audio podcast in addition to the YouTube channel video stream. So be sure to look us up on your favorite podcast resource, whether that's Apple Podcasts, Google, or Spotify. We're on all the major podcast services. But let's hop to this week's content, Viper. So, Viper, I want to go back this week to some real, I'm going to call them fundamentals of option trading. And the reason I want to call this the option trading fundamentals is we talk a lot on this show about price action and reading charts and making a buy here because we're going to test this level and go off of this level, or drop from here, reject from here. And I think there is another way out there for traders to kind of be accustomed to profiting in the market. And I talk to people here and there, and all of them want to know, hey, what should I buy? How should I invest? How do I make a return on my capital? You know, everybody, they might have dreams of mooning a stock or something like that. But most people that I talk to really want a consistent way to get a reliable and steady return on their capital. And I think a lot of videos on YouTube, a lot of traders, and a lot of things like that, they always talk about this price action, and it absolutely can get you return on your capital. But I think what is undersold or underrepresented in a lot of that is the amount of work that needs to go into that, as well as, I'm going to call it, the amount of luck, or at least your probability of success. And so what I'd like to visit this week is what a high probability trade to make a return on capital through option selling. Okay, so I want to take a look at one particular type of option, the put option, and I want to take a look at it from a option seller's perspective. And I want to highly encourage any of the viewers to go back to our beginner series on options. There's a couple of past videos. I'll link a couple of them in the description. Also, you can click one above. I decided to look at Amazon. Amazon is a big popular name. Everybody knows Amazon. And I wanted to just take a look at what does the Amazon chart look like. So let me hop over here to my screen. This is basically the chart of Amazon so far this year. Kind of coming down, up, down, up, big drop down. We had this gap up here, earnings, and I'm just looking at this thing and what do I do? This is how my mind works. How can I use this chart to create a high probability of success trade that's going to generate income for me month over month over month? And the way I do that is I sell options. And options typically have an expiration of 1 month. They have one every month. And so when I look at this chart, Viper has some excellent episodes in the past where he goes through a detailed charting. I have a quick and dirty. I'm going to throw them down. Here are some daily levels off of these candles that were interesting to me. Down here we have a bottom. We have this pinch thing. We got another level here and another level here. And I'm like, these are all movements that Amazon is in. If I look at the overall kind of trend here, it looks like we're kind of coming down, and we start kind of ramping back up. And so I'm like, hey, Amazon is kind of in a bullish trend right here. At least I think so. And so how can I create returns on this bullish thesis in as high a probability of success as possible for me? Okay. I could certainly go out and buy shares. I could buy 5 shares, 10 shares, 20 shares, 100 shares. I could buy different amounts of shares. The problem with buying shares is I don't really know if Amazon is going to take off from exactly where it is now, or is it going to fall for a while before it takes off? How long is it going to take before it takes off? Is it just going to kind of whiffle waffle around here for a month, 2 months, 3 months, the rest of the year? Are we just going to shoot to the moon tomorrow? Like, what's going to happen? And this is where option selling comes in, okay? And I'm going to highlight here how this creates a buffer. I call it a buffer for your trade. So a stock can go, I'm going to call it in a few different directions. It can go way up. It can go up. It can go nowhere. It can go down, or it can go way down, okay? So we got a couple of extremes. The nice thing about premium selling, specifically, put selling, is you will win, you will profit in every direction but one. So if you think of the choices I just gave you, that was, 5 different directions. And the option play that I'm going to talk about will make money in 4 of those 5 directions. You could simplify it and say it either goes up, down, or stays sideways. But still, if those are your 3 choices, you will profit off of 2 of the 3 directions. You only lose money in 1 of the 3 directions. If I long the shares, buy the shares outright at this price today, I only make money in 1 direction, and that's up. If it goes sideways, all I'm doing is holding up capital, not getting any return. If it goes down, I lose money. So effectively, I lose money if I buy shares if it does not go in my direction. So I looked at the option chain and I said, you know what? I like a 125 strike, okay? That basically means I will sell a coupon that says if Amazon is below $125 at the end of this period, I will buy the shares for $125. In order for me to take that risk, I will expect to be paid, in this instance, this example, $435, $4.35. That premium I am collecting at the time that I sell the option. And what that does is I'm going to just throw a box up here, and that says I get to keep that premium if the stock goes way up. If it goes up a little bit, if it goes sideways, if it goes down, as long as it stays above this yellow box, that's profit. Now, below the yellow box, this is, the way down, okay? But even if this stock kind of traces back, wanders around, dips up, dips down, anywhere above the bottom of this yellow box, I make money. Anything above the green box, I make 100% of the money that I sold. And what I want to highlight here is what this is doing is this is creating a lot of buffer for error. So this stock can go nowhere from here, right? Maybe we go up to 142. It's at $134. Maybe we go up to 140. Maybe we go back down to 130. Maybe we go up to 100. It doesn't matter where it goes. I'm going to pull in $435 in this trade, and I can sleep at night. I don't have to worry about, did I buy at the right part? Should I sell now? When do I sell? Because I guarantee you, as soon as this stock starts ramping up to the moon, you're going to be like, yes, we're going. And you don't know when it's going to turn around. And the timing is very, very important to nail the execution of those trades. And Viper, I don't know how this hits you, but to me, this option approach kind of softens the blow to being wrong a little bit, because you can give a large margin of error and still walk away with quite a bit of dollars.
Yeah, absolutely. And I mean, it's one of the things that I went through a couple cycles of, naked put selling. Uh, there's the complexity of it, like, I mean, options in general are intimidating. You hear people talk all the time about how dangerous they are. All of these things have very good founding, um, but it's still worth understanding the machine, understanding the beast, because kind of like you were talking about, like once you understand the mechanics of this naked put, and combine that with your intentions, and that is a very key Venn diagram overlap here. Um, it becomes very powerful to do what you said and opens and give you this opportunity for return before having risk of being down on a position. Even though if we're looking on we're talking about this on a time frame of bullish on an underlying in such a way that you will not accept being down on a position. Like, you will just hold this thing for years and years if you have to, because you're bullish on it. However, is anybody going to turn down the opportunity to take a little bit, or to have a chance at a little extra, in that pursuit, a little extra profits? And so that's where a lot of this really strikes a chord with me once you understand the mechanics of it. But I do, just want to pause and definitely call out the dangerous nature of options, because while we're talking about naked put selling, that doesn't mean, naked any selling is great. Like naked call selling, ridiculous, like you drain everything, so we're obviously not unpacking that stuff here, but just calling out that options can be very risky. But what I hope we can help understand here is the beauty of the naked put when you're bullish, because it has this one direction move to it, that it, we want to be bullish. We expect it to go up. And so this gives us extra profits in a one direction move.
Yeah, one thing I might say, I brought the chart back up here again, because another way you might frame this thesis is not, I expect it to go up. Because I told you, you can kind of profit in, more than one direction. What I'm really thinking in my head when I look at this is, I don't think it's going to go way down. So my thesis is, I don't know when it's going to go up, up, up. I don't know when it's going to go sideways, but I'm pretty confident crashing down below, down here, is not in the table. And that is really the thesis that I think is more important than your overall sentiment, because you could be bullish, you could be sideways, it doesn't matter. But really what matters is, are you opposed to the direction in which you lose? And in this thesis, I am. I don't believe it's going to go way down. One of the key factors of the option trade, it is a very, very time-bound trade. And that is this box width. It is specifically this width for a purpose. And that is, this is when the option expires. At the end of this green box, the option is done, gone, and worth $0. No value left whatsoever in the option. And part of what you're playing with the option game is, you could be wrong in direction, but you want to be confident in your reasoning, at least within this time frame. So maybe Amazon does go down to $100, but if it does that after this time box passes, it doesn't matter. So this is a very shorter term trade. I like to do these in the 35 to 45 days to expiration, is usually as high out as I like to go. I like to keep them less than that. So I'm usually a month out. And that's very important to remember. So let's take a look at some of the details around this. So I put together a couple of numbers to put here, or to talk around. So this is all about Amazon. So here we are, as we're selling a put. This means that we will buy, someone can put 100 shares to us at $125, and we are obligated to buy them. So our thesis is, we believe Amazon will not drop significantly below $125 within the next 58 days, because that is the length of time that I opened the option for. So the thesis is, again, Amazon will not lose big. So we look at the chart here. I took and sold $125 put 58 days to expiration, which is October expiration. It's a little bit longer than I like. It just happens to be in the cycle that we're in. I only deal with monthly options. They have the highest volume. This is where I pick this strike. I collect $4.35. This represents 100 shares. So as soon as I sell this, I put $435 in my pocket. Now, my broker who underwrites or basically backs up my trading says, okay, there's a possibility that Amazon is going to go down here and you're going to be assigned some shares. So you, means me, need to put up what's called buying power. So I have to surrender, in this particular case, $2,300 to make this trade. Now, depending on how the cost is, depending on the volatility, that buying power is going to vary on the trades. But in this particular case, I have to put up $2,300 to collect $435. One note here is, as the price moves, that buying power usage will change. So it could get bigger and it can get smaller depending on how the price moves. So just keep that in mind. Look up a little bit. I'm not going to go into the detail here on the naked trades, but the naked trades will have buying power that will change over time. So what this means is this trade has a 19% potential upside. That is basically derived by taking the $435 that I collected divided by the $2,300 that I had to surrender or put in escrow while the trade was on. So my capital usage is I put up $2,300 in capital. I collected $435. This is over about a 2-month period if the option goes all the way to expiration. Divide that by 2, you're talking approximately 10% a return a month on this. Not bad. Worst case, you buy Amazon for $120.65. Well, wait a minute. You say, I thought you said you had to buy it for $125. This is true, but you have to remember you have $435 in your pocket. So you collected that. So your cost basis, if you have to execute on these shares, is actually $4.35 lower than your strike price, which is in the previous chart. That yellow box is the area below your strike price where you can still profit because it's above the premium you collected. The last thing I want to mention here is you'll hear a lot of terms on Greeks, and we're not going to get into the detail of the Greeks. But because we want to talk about high probability trades, I want to call out a special Greek called delta. And what delta means is delta is effectively the amount that an option changes price for every dollar move in the stock. So the particular strike price that I sold was what's known as a 30 delta. And that means that if Amazon goes up $1, the price of that option goes up 30 cents. If Amazon goes down $1, the price of that option goes down by 30 cents. Now, this changes over time because as you move around, the delta of the option strike changes, but it is very close to the equivalent of the price movement on 30 shares of Amazon. So this one measure of what delta is. The other way to look at delta is it is the percent or the probability that a particular underlying will be at that price at the time of expiration. So in this case, the 30 delta means there is a 30% chance Amazon will be at $125 or lower at expiration. So we sold it. So we look at the inverse, which means we have a 70% chance that it will be above $125, which means we have a 70% chance of being right on our trade and a 70% chance of winning.
So one thing I want to call out about that buying power and the buying power pressure and whatnot, I mean, correct me if I'm wrong, but the buying power will never expand beyond what you've already accepted you're willing to pay for these shares. So in that meaning, you entered this thinking I want to hold 100 shares of Amazon, and so therefore you knew that you needed $12,500 at 125 put. So if you wanted to, not have to worry about that buying power expansion, just keep that in your mind of buy expiration, or let's even say, just to be super safe, say like 10 days to expiration. I need to make sure that $12,500, and this is even excluding the cash you pocketed. You take that cash, whatever. I need to 10 days before expiration, I need to have $12,500 available. As long as you do, then you don't need to worry about that buying power expansion. Where that buying power expansion needs to be in your mind is when you get more comfortable and you want to start rolling different other tickers, that you want to go long, or not go long, but you want to sell puts on, and maybe you start to, work the capital around a little bit differently there. But that was just one point I wanted to call out about that buying power.
That's right. And really, depending on your trading account and what level you're approved for options trading, some trading accounts, when you sell a put like this, will actually require you to do what's called cash secured. So instead of only ponying up the $2,300, they'll ask you to put up the full $12,500. That makes it very clear that that's as much money as you need to put away. That will dramatically change your return on your capital, because now you're ponying up $12,500 to make $435. Yeah, so if you have a cash secured account like we're just talking about there, and you have to pony up the $12,500, you're still getting a 3.5% return. So yes, it's not the 19%, but 3.5% is still pretty decent type of return for that type of capital and that type of short term, 58 days. Speaking of capital requirements, I mentioned the 30 delta is where it means it's similar synthetically of owning 30 shares of Amazon. Well, and this is with respect to price movement. But if you went out to buy 30 shares of Amazon today, which are currently closed at $134 a share, that's going to require $4,020 in capital to buy the 30 shares. So to get the same feeling of price movement, you would have to put up $4,020 in capital versus the $2,300 in capital for selling the put. So it's really just kind of trading off the efficiency use of your capitals. And selling the put requires less capital allocation, but you collect a good bit, so your return on capital can really change. And that 19%, Viper, it's kind of an interesting number because that's pretty good for anything in 2 months. And people could balk at that and say, what? Psh, come on, Amazon can run up 50, 45% in a short amount of time. And I could blow away these returns. And I don't, your 19% is peanuts. And that's true. That's true. It absolutely could happen. But I want to go back to the original thing that I said I liked about options is it puts the probability of success in your favor. Okay. These other moves, is it possible? Yes. Is it likely? Not as likely. I don't know what the actual probability of doing something like that is. But it's not 70% chance. It's not 70% of the time you hit, a 50% gain or a 45% gain on Amazon or any equity, because timing a market while looking at charts and things, you're like, oh, that's so easy. I could do that. See, look, it happened here and here and here and here. But actually being in that moment and making the trade, knowing that's what's going to happen or having the ability, I think you're going to miss a lot more than you hit. And that's where I equate, yes, we have less upside potential. We're capping it, but we're going for singles here. We're not going for grand slams. We're not going for home runs. We want simple singles, single after single after single.
Yeah, absolutely. And I mean, let's keep in mind a couple things. One, check my math, but 20% in 2 months. And let's say, as long as you don't get hit as in assign the shares, and then you roll into another play just like that. Maybe something else also has your attention. Maybe it's not Amazon. Maybe it's Amazon again. 20%, 2 months. Annualized, we're now looking at 120%. Annualized on that same capital, assuming that you're rolling that forward. So that's number one. And number two, we have the notion, not notion, but the studies that show 95% of people who trade and try to day trade will lose money. That's who we are. That's how like it is very difficult. And the reason they fail is not, oh, they're just terrible at it. It's lack of discipline, and that's not even a fault of their own. That's the what you mentioned there. When you're in the moment, when the thing is moving in the opposite direction of what you want, and in order to catch that knife, you have to see red. Like, so in this bullish case, you have to see red. I'm going to buy. I mean, it's not, that's, anyways, you have to be disciplined enough to make the trade when every emotional instinct in your body is telling you, don't do it yet. Wait, just wait. And that's where that statistic comes from of 95% of traders failing, that is hard. It's really hard. So I wanted to put this into some more perspective here, over on my chart. So we were talking about 19%, 2 months. So we can see, my chart here, I actually have the same levels charted out that Sprocket did. So we'll actually just kind of throw these away and remove them for a second, just to declutter what we're looking at. So what I did here is I basically drew that same box that was on Sprocket's screen there. And this box is actually measured to be 2 months wide and 19% tall. And what I wanted to do was just kind of show how unlikely that you could consistently harvest that 19% out of just spot trading this stock. I mean, we're looking at the chart here, and we're going all the way back to July of 2020. So we're going back, almost 2 years worth of chart here. And if we slide this box around, what we're looking for is how many times do we get 19% on a trade within this box? And what you can start to see as I slide this around is you can see that, yeah, sure, it happens. It happens on a lot of these moves, but look at how fast it happens. We get, we go in at the bottom of the box, and on any of these swings to get the full 19%, I'll zoom in here just so we can, see a little more clearly. You really have to time this thing, time it perfectly, because I mean, look at every time we slide over one of these peaks, that's it. For this time window, you get one peak, you get one shot at closing that thing out for the full 20%. And that's just, do people do it? Can people do it? Absolutely. But we're going into the mindset of, this isn't your day job. You have a day job, and your day job is not worrying about what's happening here. You just want to set up a play, and you say, I want to hold this thing long term. I'm at least bullish on the direction of the chart, but I'm also willing to buy these shares to do that at this certain price. So I thought that was an important visualization of, that it can happen, but, I mean, even so this peak here, if we zoom in, this was one thing that caught my mind, because I know that even selling naked puts is still emotional. I mean, I've been there on them. You sell it, or you worry that you're going to sell it and the price is going to move on you, and then you would have been better off holding the shares. But this peak right here that we see that the price, we start in the bottom corner, and again, this is assuming a lot on your entry, but we start in the bottom corner, the price goes up, it exceeds the box, and so this would potentially be one of those emotional scenarios where it's like, I would have been better holding the shares. But we can clearly see the price action that we go up, we exceed the box by quite a bit. And then by the end of that 2-month period, we're right back where we started. Where, it comes crashing back down. And the beauty of this naked put is as price goes up, the cost of that option keeps going down, which means you can close out and wrap this thing up. You don't have to wait the full width of this box. If price is going up as fast as it is in this move, you're done. As soon as it gets, let's get the pencil out here. As soon as it gets, these are a rough area, but as soon as it gets up into this area here, you're probably a solid 80, 90% in profit on that money you harvested out of this at the beginning. And so you're not waiting until the end of this. You just close it up. And, well, I didn't get my shares that I wanted, but I did get this, at that point, 17, 18% profit. And now you're sitting there right where you started, not being exposed to any of the stock, and you have that 17, 18% profit. And so now you're ready to do it again.
Yeah, Viper, to your point here, actually, this is something that is also, I want to kind of call out because, this box, we basically start and end in the same place. We went way above it in the middle, but let's just talk through what might happen in somebody's head. And I know the viewers out there, they're going to say, nah, I'm never going to think like that. That won't happen to me. I promise you it will. I promise you. You're going to buy. You're going to go up. You're going to be at the top of that peak, and you're going to be like, yes, this is awesome. I'm up like 20%, 25%. This is so cool. And then you're going to get some red candles, and you're going to be like, oh, I should have sold. Oh, man, I missed it. I might have missed it. Is it going down? No, it'll come back. It'll come back. Just wait. It'll bounce back, and you'll hold it. You're going to get some more red candles. You get a little green one, you're going to get some more red ones. And you're like, oh, shoot, now I'm down to 10%, or now I'm down to 15%. Now I'm down to 12%. It's going to come back up. And you'll get that little glimmer of hope. You'll get a little ramp up somewhere. You'll be like, okay, it's going. All the while, time is passing. And then pretty soon, you're going to be at the end of that 2 months. And you're going to say, shoot, I'm right where I was 2 months ago. And you holding shares are going to be right where you were 2 months ago. You didn't lose any money. You're really sad because you went on a stressful roller coaster ride, and I sold the put, and I'm like, you know what? I got my 19%. That's cool.
Yep. And I can say the following with the utmost confidence because I've done it. Is in the scenario you just laid out, this move right here on the way back down, this is the exact thing that's going to snag you. If you're holding those shares. So we have the run up, we get this big peak, and you're just on top of the world, and you're like, yes, this is amazing. I nailed it. And we're just going to give it to you. We're going to say, you nailed the bottom entry. You got in there perfectly. So you get up here and you're like, I'm up. Yeah. I mean, this move here is about 25%. I'm up 25%. I'm awesome at this. And then, so I'm not selling because this thing now on the big grand scheme of things, you're like, now it's just going to keep going. And then, like you said, you start seeing these red candles. And so as we see this move down, it's a significant move down. We're gapping day over day. And then we get a bounce, and we get this bounce. And this is a healthy little bounce here, probably to the tune of 10%. And that's the snag. That's the trip right there. Because you get that bounce, and then your emotional confirmation bias comes in and says, okay, there it is. We're going back, thump, and it goes right back down on you. And so you're back where you started. So, that's assuming a lot of behaviors. However, having expressed and experienced those behaviors, I can say confidently it will and does happen over and over and over again to the tune of 95% of people.
Absolutely. So, Viper, I don't want to make it sound like selling naked puts is easy money because you said, "Oh, look, that's an annualized 120% return a month or a year." Guess what? I don't return 120% a month. I follow this strategy. I don't get that a month. I don't get that a year. The reason is, remember, I'm only winning 70% of the time, which means 30% of the time I'm losing. The key point is those losses are controlled and the gains are very steady. Dink, 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 dink. And so my annualized performance has been in the realm of 40 to 50% annualized, because you take losses. You can't find these setups all the time. You miss them. It doesn't matter. The key point here is this a way to trade. Once you understand it, once you see it, go watch more videos, go read up on it. It gives you peace of mind or comfort. It's not a fast moving, yes, it's emotional, yes, things are, but once you start to understand it and kind of come to terms with how it is, it really is a way to step up to that plate and hit single after single after single. Are you going to strike out a few times? Absolutely. But when the game is done, the scoreboard probably favors the multiple singles over maybe a grand slam, maybe a home run, one or two.
Yeah. Yeah. And the last thing I want to call out about it all is um this strategy, this approach. I mean, this goes without saying for all strategies, but it's before you enter anything, have it written down. What's my play here? I mean, in this case, my play is I'm bullish on Amazon. I don't think it's going to massively go down, or at least it's not going to stay down. And so that's written down. And then it's written down that I'm okay being assigned these shares. That needs to be written down. And, you write down your criteria before you touch anything, so that you have a plan to refer to, because there are emotions going the other direction. I've also been on the other side of selling a naked put, and then we're going and we're going and we're going. And then all of a sudden I start thinking, and I'm still, maybe I'm still bullish on a direction of the asset or something, but I'm like, hey, this worked out pretty well, pretty quick. All of a sudden I don't want to be assigned these shares. But the problem isn't that I don't want to be assigned these shares. The problem is I changed my plan midstream, and that's the perfectly wrong time to do that. So have your plan, write it down. And in this particular case, absolutely, I don't have $12,500 to do this. Then you don't need to. A contract is 100 shares. It's 100 shares of the underlying. But then look at a $5 stock. You can sort stocks by price and probably every brokerage possible and website. So look at a bucket that fits your budget and find something in there. There's absolutely going to be companies in there, big companies you recognize. I mean, Ford right now, I think Ford's, I honestly don't know off the top of my head, but I feel like they're in the $15 to $25 range, maybe $10. Stuff like that. Big companies, it doesn't have to be trading at over $100 or something and require this large capital investment to do this on. You'll find companies that you might want to go long term or expect, a particular direction up on it. So there's choices.
When you look at those choices, I highly, highly encourage you to remember to look at the percentage moves, the percentage returns on capital, the percentage things, because when you get into the lower priced underlyings, they're perfectly valid for smaller portfolios, but you'll be like, oh, this is only $20. That's not much money. I want something else. I want $700. Well, guess what? If you divide out the percentage of risk on capital, you're going to get to similar numbers. So please always make sure that you're normalizing this to a percentage of your risk of capital, because that's really going to tell you the story of your return.
Yeah.
That brings us to the end of this week's episode. I hope we can kind of highlight at least some interest or perk some curiosity inside you to maybe look a little bit more into this option selling. You will see a lot on the internet about how it's scary, but start looking, because When you dig down and understand the mechanics, you really, really, really can put this in your favor probability wise. I am an engineer by trade. I love mathematics and science and probabilities and all of that stuff. And this is a way mathematically proven. I even did it myself for well over a year. And these numbers of these deltas hold true. I stuck to these 70 percent probability of profit over the course of a whole year, doing hundreds and hundreds of trades, and my end results ended up being a success rate of around 78%, which means I actually exceeded the theoretical value. And there's a whole host of reasons as to why. A lot of it has to deal with volatility, and moves are always overstated, so it really does work. It is a little scary at times. It is really boring because you're never going to moon a stock. You never hit that grand slam. The fireworks never go off in the outfield. So it's boring. But when I talk to people, most people are not looking for spectacular moves in their portfolio. They really just want a reliable, steady way to build wealth. So good luck in all your research. Hop in our Discord, say hello to us, let us know. We'd love to talk to you about more about this. Good luck out there in the markets, and remember, think outside the block.